Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Newegg.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So this is a name today that I think a lot of people are going to recognize right away.
Oh, yeah.
If you've ever, built a custom PC or hunted for a graphics card, Newegg. But the financial picture, that's a whole different story from the website we remember.
I have to admit, when I saw the topic, I had a bit of a flashback to my college dorm room trying to piece together a gaming rig.
We've all been there.
That nostalgia factor is huge. But then I opened the chart you sent over, and, well, my jaw just about hit the floor. This isn't some dusty old retailer. We are looking at some serious, aggressive movement.
It is definitely not for the faint of heart. It's volatile, it's fast, and the numbers are just staggering.
Let's just start there. Let's start with that wow factor. We're seeing a one-year return of up to 477%. That's the kind of number you see with a tiny biotech or, I don't know, an AI startup, not a 25-year-old company. So my first instinct is this a bubble? Is this just hype? Or is there something real going on here?
And that's the perfect question to start with. Because when a stock moves that fast, you have to check the fundamentals immediately.
Right, or you get caught.
Exactly. But with Newegg, the fascinating thing is that the revenue numbers, they actually back up a lot of this story. This isn't just a stock floating on meme energy.
Okay, so let's unpack that. Because usually legacy tech stores, well, they aren't exactly known for hypergrowth.
No, they're usually fighting just to stay relevant. But look at their top line. For the trailing 12 months, they brought in $1.31 billion.
It's a big number.
It's a substantial amount of volume. But the number that really signals a shift, the thing that tells us this isn't business as usual, is the quarter-over-quarter growth. It's up 12.5%.
Which for retail, especially consumer electronics, that's huge. You're usually happy with 2 or 3%.
Exactly. It shows demand is accelerating. But here's the stat that I think explains that massive stock jump. If you look at the revenue shift from 2024 to 2025, there was an increase of approximately 165%.
Whoa. Hang on. Say that again?
165%.
That is not a legacy retailer growth rate. That sounds like a Silicon Valley software company. How does a company selling motherboards pull that off?
That's it right there. And that is why the market is reacting like this. It suggests they're scaling up in a huge way, probably cashing in on the AI hardware boom, right? Everyone's upgrading GPUs, servers.
So it's a momentum play. The market is betting that if they sell that much more stuff, eventually they'll figure out how to keep more of the money.
That's the hope. It's the classic Amazon playbook, really. Get big first, worry about profit later. But, and there's always a but, we have to look at what they're actually worth versus what they're losing.
Right. Revenue is vanity, profit is sanity. So valuation. With that crazy growth, is the stock just incredibly expensive now?
Surprisingly, no. And this is where the value argument comes in. If you look at the market cap, it's hovering around $923 million to, say, just over $1 billion.
So $1 billion company, give or take.
Pretty much. But look at the price to sales ratio. That's the metric that tells us how much we're paying for every dollar of their sales.
How much revenue am I buying with my share?
And Newegg is trading at 0.7 times sales.
0.7. So I'm paying 70 cents to buy $1 of their revenue.
Essentially, yes. Now, for context, the industry average is around 0.5, so it's a little higher than the general sector.
Yeah.
But, and this is the key, the peer average, their direct competitors, it's 1.1.
Okay, wait, let me get this straight. Their direct competitors are trading at 1.1 times sales. Newegg's at 0.7. So the market is saying Newegg is way undervalued compared to the other guys.
That's the implication, yeah. The market is pricing them at a discount.
Sure.
Now, that usually happens for a reason, and it's probably the profitability concerns. But on a pure sales basis, you're getting a deal.
Which sounds great until I play devil's advocate. I'm looking at the bottom line here, and look, well, it's red. A net loss of $22.6 million. Operating margin is negative 1.1%.
It's not pretty.
No, it's not. They're losing a penny on operations for every dollar they sell. How do you reconcile that with a bull case?
That is the reality check, and that's why the stock is so volatile. You can't just ignore a loss that big. However, and this is where it gets really interesting for anyone who looks deeper than the headlines.
I knew there was a twist.
There's a silver lining. And it's called cash flow. There's a big difference between net income on paper and the actual cash coming in and out of the bank.
Okay, so are they burning through cash?
No. They're generating it.
Hmm.
Free cash flow is positive. It's sitting at about $500,000 for the latest 12 months.
Wait, so they posted a $22 million loss, but they actually generated positive cash.
Correct. And the projections see that doubling to over $1 million in 2026.
That totally changes the narrative, because if you're cash flow positive, you don't need to go out and dilute shareholders just to keep the lights on.
Exactly. That is the biggest fear with a company losing money: dilution.
Mm.
But if Newegg is generating cash, they have breathing room. They can reinvest that money into growth, like their B2B logistics arm.
That's a crucial distinction. It's the difference between a business that's dying and one that's just investing heavily. Okay, but let's talk about the business itself. What's their moat? Why do they still exist in a world with Amazon?
That is the billion-dollar question. And the answer is niche dominance. Amazon is the everything store, right? Toothpaste and lawnmowers. Newegg has spent 25 years building a fortress around the gamer and tech enthusiast.
Right, the people who actually know what clock speed their RAM is.
Precisely.
Yeah.
And that creates what we call high switching costs.
How so? It's easy to just open a different website.
You can, but think about it. If you're a serious PC builder, you need curated inventory. You need filters that actually work for technical specs. Amazon search is, frankly, terrible for that. Newegg's customers are stickier because Newegg speaks their language.
That makes sense. It's like going to a specialized lumberyard instead of a big box store. The lumberyard guys actually know what you're building.
Perfect analogy.
Yeah.
And Newegg is leaning into that. We have to talk about some of their recent partnerships.
Oh, I saw this in the notes and did a double take. Are we really talking about Starbucks?
We are.
Okay, explain this to me. A company that sells motherboards is partnering with the company that sells lattes. What's the connection?
It's a cross-promotion. Specifically, you get Starbucks rewards tied to buying high-end RAM.
Buy some memory, get a caffeine boost. That is weirdly specific.
It sounds odd, but think about who's buying that high-end RAM. Gamers, developers, content creators.
People who spend a lot of late nights in front of a screen.
Exactly. What fuels a coding marathon or a raid night? Caffeine. From a strategic view, it shows they're expanding into a broader lifestyle gaming audience. They're becoming a brand, not just a utility.
Right, right. Plus, I see they're in their 25th anniversary sale event right now.
Which is a huge driver for loyalty and keeps traffic coming to the site. It's all connected.
Okay, so they've got the growth, the niche, and the coffee. But let's look at the chart. We mentioned volatility, and this thing is a roller coaster.
It is extremely volatile. We've seen daily drops of over 7%, and just recently, a one-day decline of 17.7%.
Ouch! 17% in a day.
Uh,
That'll wipe out a year of S&P 500 gains in about 6 hours.
It does. And from a technical standpoint, it broke below a key support level at $46.21.
So technically it looks broken. Why would anyone touch this? Why try to catch a falling knife?
Because of the bounce setup. This is for the traders out there. We look at an indicator called the RSI, the Relative Strength Index.
Okay, break that down for us.
Think of it like a rubber band. You stretch it too far one way, it wants to snap back.
Mm-hmm.
The scale goes from 0 to 100. Anything under 30 is usually considered oversold.
Meaning the sellers are basically exhausted.
Pretty much.
Yeah.
And right now, the RSI for Newegg is sitting at 29.4.
So the rubber band is stretched tight.
It is, and we're seeing signs of that snapback. In pre-market action, there was an uptick of nearly 4% right after those big sell-offs.
So the dip buyers are coming in, they see that drop and think, discount.
Exactly. Now, to be very clear, the overall momentum is still technically bearish, the trend is down, but those oversold conditions set up a potential speculative rebound. It's a risky play, but the setup is there.
Okay, which leads us right into the risks, the bear case. Why should investors hesitate?
The biggest reason is just the ongoing losses. We could talk about positive cash flow, but an EPS of negative 0.21 is still a loss. Until that turns positive, there's risk.
And what about the hype? Is there an army of retail traders pumping this?
That's the interesting part. No, the quantitative sentiment scores are neutral. The score is literally 0.
0, so there's no hype train at all.
Not at the moment.
Yeah.
And in a way, that's a risk because there's no floor of enthusiasm to save the price if it starts falling again.
Yeah.
It has to trade on its own fundamentals.
So if you buy this, you don't have that crowd behind you to prop it up.
Exactly. And you combine that with the volatility.
Yeah.
This is dangerous for conservative portfolios. This is not a sleep well at night stock.
Fair enough. Okay, so let's wrap this up. What's on the calendar? What are the upcoming catalysts we should watch?
The next 3 months are critical. The big one is earnings. The next report is due out after June 30th.
So we had a little time.
We do. And the baseline they need to beat is the Q4 2023 revenue of $456 million. Given that 165% growth rate, the market will be expecting a big beat.
And a miss could be ugly. What about macro factors?
Well, we're seeing some rotation into undervalued e-retail. And if we get rate cuts from the Fed, that usually boosts spending on electronics. Cheaper money helps people finance big PC builds.
Okay, so the environment is favorable, drum roll time. What is the Smart Wealth score for Newegg?
I am giving this a bullish score, but a cautious one. It's a 6 out of 10.
6 out of 10. Okay, so positive, but definitely restrained.
It has to be.
Yeah.
The volatility is just too high. My thesis here is that this is a swing trade candidate.
So not a buy and hold for 10 years kind of stock?
Not yet. I'm looking at a 3 to 6 month horizon leading into that next earnings report. You're trying to capture a specific move.
Play the bounce from the oversold levels, ride the anticipation into earnings.
And then take your profits and reevaluate. You don't marry the stock. It's an undervalued growth play with a great niche moat. But it's too volatile for an 8 or a 9. 6 feels right for the risk reward.
I like it. A disciplined 6. It's like buying a roller coaster ticket. You know it's going to be a ride and you might feel a little sick on the way.
That is the perfect analogy for Newegg right now.
Before we sign off, I want to leave our listeners with a final thought on that Starbucks partnership. It seems small, but if Newegg is pivoting to these lifestyle plays, does that change your view of them? Are they still just a computer parts store, or are they becoming a gamer lifestyle brand? Because that's a much bigger market.
It's a great question to ponder. If they can own the culture, they can own the customer.
Something to think about. That's all for us today. As always, do your own research, and we'll see you next time.
See you next time.